Good morning, all. Thanks for joining us. I'm assuming everybody is on and logged in. I was waiting there for the recording in progress message to kick off. But again, thanks everybody for joining us today for the CAPIS sponsored panel on ETF essentials. I'm joined today by Chad Mueller and Patrick Nolan. I'm Steve Sachs. I'll do introductions in just a moment, but again, appreciate everybody's time this morning. And we were actually just talking as we were kicking off about just how topical all things ETFs are. We're going to cover a number of topics today, including at the end, probably a little bit about Bitcoin, which I think is also, very topical to everybody these days. But again, Steve Sachs, I'm the Global Chief Operating Officer of the Goldman Sachs ETF Accelerator. We're a platform that actually allows our clients to come in and launch, list, and manage their own ETFs and do it faster and cheaper, quite frankly, than they could do it on their own. I've spent about 9 years at Goldman, not only building out this business, but the GSAM ETF business as well. So a wide variety of experiences on the panel today. And Chad Mueller and Patrick Nolan, I'm going to turn it to both of you to introduce yourselves. Chad, why don't we start with you?
Good morning. Thanks for joining us. My name is Chad Mueller. I am the U.S. Director of Equities here at CAPIS. I've been at CAPIS for 23 years. Prior to CAPIS, I worked at Ameritrade for about 4 years, and I'd also done an internship there. So I've been in the finance and trading industry for a little over 25 years.
And Patrick?
Steve, I'm glad to be here. Thanks for having me as well. Patrick Nolan, I am the Director of Investment Strategy with First Citizens Bank, responsible for day-to-day portfolio management of our wealth platform assets here for both trust and RIA clients. I have been with the bank now for 3 years. Started my career at Merrill Lynch Investment Managers, worked in their asset management unit for about 10 years or so early in my career. Moved over to BlackRock when that unit was sold to BlackRock in 2006, was at BlackRock for the last 15 years or so prior to joining First Citizens. Again, thanks for having me. It's good to be here.
Great. Patrick, we're going to start with you. You're an asset allocator, right? You're at the tip of the spear of selection of ETFs, usage of ETFs in client portfolios. There's been a real transition in the industry, obviously, firms moving away from mutual funds, adopting ETFs instead. Can you talk about this shift, and particularly from your vantage point and what you've seen?
Sure. The First Citizens clients have been using index investments for many years now. It did start originally, that exposure in client portfolios generally started with mutual fund exposures, where ETFs were used a bit more sparingly to gain that index exposure. We've been combination of both index and active dating back many years before I arrived. We, in the last few years, have accelerated the transition of index mutual funds to ETFs, and have also made a transition of a number of active mutual fund strategies also into ETFs as well. So as a vehicle, the ETF has become our preferred vehicle of choice, where we've been steering both former index mutual fund assets as well as active mutual fund assets towards ETFs. And today, our core strategies utilize roughly 65% or so in ETFs, with the remainder generally being mutual fund exposures. Of course, separate accounts are part of that mix as well, where appropriate.
And do you see this continuing? Is this, I've often joked that this whole ETF thing might just be a fad. 30 years later, I certainly don't think that that's true. Is the trend going to continue? Is it headwinds? Is it tailwinds? What do you think?
Yeah, I think we have to separate the notion of the packaging of an ETF with the strategy of indexing, because the industry continues to evolve, as everyone knows. So ultimately, the packaging of an ETF offers many advantages to end consumers. The thing that we really focused on and gravitated towards ETF usage was around lower friction in the form of lower cost. Generally, we could get cheaper expense ratios out of the ETF space, and also a more tax efficient vehicle that benefited clients that were sensitive to taxation. So those two sources of friction we were able to reduce in our client portfolios. I don't think, unless they change the tax code and everyone ends up with tax-free investing everywhere, I just think the benefits that ETFs provide are going to make them a considerable vehicle of choice. What the industry, I think, needs to continue to do, and it's doing this, is just continue to evolve, right? There was a point in time where indexing was first created, even before the index mutual fund was created. And then we had the opportunity to consume an index mutual fund to gain access to that benchmark exposure that people were looking to digest. It wasn't until many years later that we then started to see the ETF as a potential replacement to the mutual fund. However, importantly, at that point in time, you were still talking about the very traditional cap-weighted benchmarking, the S&P 500, the Russell 1000, EFA, et cetera. And the evolution since that point over the last couple of decades has been profound. It gives allocators like us an opportunity to consider gaining access to rewarded factors, gaining access now more recently to more and more active strategies where that very active manager that we're considering should we or shouldn't we own, we no longer have to actually worry about the packaging of the mutual fund wrapper and the added costs that may come with it. We now have the ability to consume that in the packaging we preferred to own as well. So I just think as long as the ETF industry continues to evolve and give allocators like us access to all the different types of exposures that we're looking for, I think the ETF has to continue to grow in its usage.
Yeah, look, I think that's a great point, and maybe preaching to the choir a little bit. But look, the reason the Goldman Sachs ETF Accelerator platform exists is exactly that. The sheer number of clients, asset managers, banks, hedge funds, family offices that were coming to Goldman and asking, what's the roadmap to launching our own ETF? Because essentially, we now want to package our active strategy in an ETF wrapper and deliver that to our clients for all of the things that, Patrick, you just talked about. And Chad, I want to get to you on trading, but maybe a good segue is, given my experience in the ETF capital markets seat, particularly as it relates to this intersection now of this not only continued growth in the ETF wrapper, but now more and more active strategies coming to market. When you think about the statistics don't lie in the US, 2/3 of all ETFs that have been launched in the last 4 years have been active strategies, not passive. Active ETFs over the last 3 years are garnering 25% of the total AUM flow. And this is, 3 of the last 4 years have been a record year for the number of ETF launches. So we're not talking about a handful of funds. We're talking about, the largest players in the world coming to market, along with, quite frankly, some of the really good, unique, smaller, more boutique players now bringing their active strategy in an ETF wrapper. And Patrick, to your point, all the advantages of that. But what's one of the things that you need to think about, I think, from my perspective, when you think about the selection of an ETF, having sat in that capital market seat throughout a good chunk of my career, strategy matters first and foremost. And Patrick, I think you would agree. At the end of the day, what you want to select is the strategy that works for your client and your asset allocation. But the difference between the mutual fund and the ETF wrapper really is that exchange traded aspect. And I'm going to lead the witness here with Chad a little bit. But before I do that, I want to talk a little bit about what are the things that at least I historically and traditionally have either looked at from a selection perspective, as in building portfolios with ETFs, but also more importantly, educated advisors and asset allocators on. It's really that exchange traded portion of it. And that really starts with, quite frankly, a lot of the questions around how do ETFs work? How does the creation redemption process work? How does that actually lead to liquidity? And quite frankly, the one thing that I always leave everybody with in this conversation is, first and foremost, every ETF is as liquid as its underlying basket of securities. So it always starts with, what is that strategy and what are the components of the ETF, whether it's equity securities, fixed income securities, futures, options, other derivatives. That's ultimately where the secondary market, i.e. the trading of the ETF on exchange, derives its liquidity. And why is that important? It's important from the perspective of it doesn't matter who you are, whether it's us doing this in our Schwab or Fidelity brokerage account for our own personal IRA, or the largest institutional investor, a sovereign wealth fund allocating billions of dollars for a global asset allocation model. Everybody interacts with the ETF in the exact same way. The E part of it, on exchange, through the brokerage function. And the basis for that is, as I often say, market making is a pretty simple equation. Cost plus risk equals market. So how does the market decide on what the appropriate price is? It starts with that equation. What drives that equation? The liquidity. What's the ETF mechanics, the creation redemption process, and what's that liquidity of, the underlying ETF itself? What's actually traded in the secondary market at any given moment or day, I think is generally a little less important. But Chad, I'm gonna ask you, one, agree or disagree with that, and then talk to us a little bit, starting at the highest level. How do you think about trading ETFs, right? You're the expert here. This is what you do all day long. Let's start with an example of you've got a large block of an ETF to trade, whether it's large by absolute terms or just relative to the ETF itself. Where do you start? How do you think about it?
Thank you, Steve. Yeah, so 100% you're correct. When it comes to liquidity on an ETF, so many times we get the question, is this too large of average daily volume? Should we VWAP this? Things of that nature. And like you said, it's all based on the underlying, what is the underlying participants of the ETF? And that's how we're going to determine what the liquidity is going to be able to handle. And the nice thing about ETFs is the way that CAPIS is set up, the way we've set up our trading desk, being an agency-only model, we have combined our forces with all the large APs and market makers out there in the street, and therefore we put them all in competition. So let's say that you guys would come to me with what appears to be a liquid ETF, 500,000 shares. I'm going to go to all of our partners, ask them for a two-sided quote. Because we're agency only, we're going to them. They know that we have an order in hand, that it's a clean, we're not fishing, that it's a clean order, and they're all going to give us the best possible price that they can put together for us, bid and offer side. At that point, if one of the prices looks good to what our customer likes or what we as a trading desk has decided is a good price, we'll trade that piece right there, right in line, and we're able to move large size, very large notional without affecting the marketplace, which is very unusual compared to traditional equities, or even, the fact that you can do it intraday versus mutual funds where you have to wait till end of day NAV.
And I think that's great. I obviously, again, preaching to the choir a little bit there. Can we unpack that a little bit more? Help us understand a little bit more deeply when you think about applying the things that I think many of the people on this call that are listening in understand. VWAP and dark pools and liquidity seeking algorithms as you think about going out and seeking liquidity for an individual equity security, small cap, mid cap, even large cap. Compare and contrast that a little bit more around the tool set that you should or even shouldn't use as it relates to ETFs.
Sure. So the first one you said was VWAP. That's been a buzzword for 20 years now, and it's become a very comfortable norm. The unfortunate part is if you try to VWAP too large of an ETF, there's a very good chance that you're going to push that order throughout the day one way or the other, because at that point, if you're just trying to strictly VWAP it, you might not get any authorized participants to commit any capital and get in front of it, and therefore you're going to be the driver. Where if you do get an AP involved, now you can eliminate that pushing of a name and getting it done tight in line. The biggest difference between in a liquid equity versus in a liquid ETF, those liquid equities, we talked about it when we were planning for this. It used to be, you could go out to someone and get a two-sided quote for, 500 up, and you'd be able to get it done maybe back in the 90s. But that's completely gone when it comes to, actual equities now. The thinly traded names that are not ETFs, you are forced to piece those out, tiny, tiny pieces all day long. Maybe it'll take you a week, a month if it's a very large position. Where, what we've come across in the ETF world is we're doing, multi-billion-dollar rebalances all in one day and keeping those scores very tight within a couple basis points of the arrival, which is just unheard of if you're trying to do that with a large basket of equities.
Yeah, and I think that's another great point. I think when you think about, again, what we've talked about so far, from Patrick's point of view, the asset allocator, I touched a little bit on security selection, and now sort of let's wrap up the trading conversation and put a fine point on it relative to there's the execution of an individual ETF trade. But then how do you think about a rebalance? Because more and more, your clients, our clients, Patrick, they're building entire asset allocation models of multiple ETFs and deploying that way. How do you think about a rebalance trade across an entire portfolio? Do you think about it the same? Is it different?
It's a little bit different. And the reason why I say that is we're going to take that basket, put it into our basket monitor, and we're going to look to see how close to dollar neutral are we on this basket. If we're relatively close to being in line, we're going to get us to a dollar neutral point. And at that point, we are going to start trading these things, not just going to APs and trying to cross the entire basket all at once. We here at CAPIS, we're going to work that order for you. We're going to take the more liquid names. We're going to use some of those dark pools that we might be able to capture, the midpoint. Or I'll use some passive algorithms that we have that allows me to buy on the bid, sell on the offer. And I do that while we're getting dollar neutral. And then I go to the illiquid names. And at those, I'm going to go and try to find the best price from all of our APs, those two-sided quotes that I spoke of earlier, and start working my way through those. And, I'll try to do a buy and a sell that's close to dollar neutral and continue keeping that dollar neutrality through the whole thing. And by doing so, over some of our big rebalances, we're coming in within a couple basis points from where we start, which is just almost unheard of when you're dealing with actual equity baskets. Because with equity baskets, it's almost inevitable. One side moves against you because you're hoping that, your buys are going higher and your sells are going lower. Unfortunately, when you're out in the marketplace and that starts happening, your score really starts to move away from you. Where in the ETF market, we're able to really keep those a lot tighter and move our feet faster than you can in the equity market.
Yeah. Patrick, I'm going to come back to you. How wrong are Chad and I? So is this what you think about from an asset allocator's perspective, an actual investor? Are we touching on the right things? Do you think about this in your ETF, security selection and deployment, or are Chad and I completely off base on this?
No, I don't think you're off base at all. And I would say, look, the larger the scale that you are trying to operate in as an allocator, the more you have to think about the execution component of the trade. Chad and I have spent a lot of time on the phone as we were doing reallocation trades where I knew we were removing sizable components of our portfolios, particularly when we were making that first transition, taking some asset classes into ETF exposures. And we talked about, the different components of the trade and the way Chad was going to approach it. And, the thing that gets talked about less as it relates to just ETFs in general is this idea that, they can and do trade at premiums or discounts on any given day, right? And, simply said, on a day that I'm trying to get a reallocation trade done, I don't want to be the only buyer at a premium on that day, right? So the strategy that's deployed by someone like Chad and his team, is important. It's why we've spent time talking on those days in preparation, to get ready to make sure the execution's as good as it can be. Like I said, I'll end that question where I started it. It's probably less of a concern at smaller dollar amounts, but as the share counts and the dollar amounts get bigger and bigger, it's something that everybody along the activity chain here has to really be mindful of.
Which is great. And I think this is a great pivot in the conversation to a couple of the hotter topics now, and I'll open this up to both of you, and we'll start with I'm going to save the $60,000 question, for the end, and only Patrick and I are old enough to understand the reference on the game show on that one. But let's start with misconceptions. So beyond what we've talked about, to date, liquidity, in the panel so far, we've talked about liquidity. There's a little bit of a misconception there, right? That just because what's on the screen doesn't mean that's the only amount of liquidity that's available to you. Patrick, I think you just touched on something that I think is very important, in that we tend to focus on bid offer on screen, because why? That's what we can see right there. You touched on premium and discount, and I have often, said that is far more important, because that's what's going to drive your return, right? That's going to drive your ultimate experience, in the ETF. So putting aside those, Chad, I'll start with you. What are some of the other big misconceptions in the ETF space? If you had to pick one off the top of your head, what would it be?
I think the one thing that always comes up on almost every conversation is truly it's liquidity. And I know we just kind of keep coming back to it, but so many times a customer, is looking to get in or out of a very large position, and they look at that 30-day average volume or the 10-day average volume, and they're like, there's just no way. They're like, is this going to take us a week? Is it going to, how long do you think this will take? And, when I explain to them, it's based on the underlyings. And if you're good with buying or selling this here, I can go and get you, two-sided quotes, get you the best quote, and we can make that decision together at that time. The other thing that I would like to, kind of piggyback on what Patrick was saying is, when you are dealing with these large rebalances, the conversations leading up to the day of trading, that's just as important, because it gives, it gives myself and my team the chance to look at those underlyings and see, maybe it's one of those where this position is going to be too large to just do a two-sided quote, and we are going to have to do, a couple hour, guaranteed VWAP on the underlying basket, and we have the ability of doing those kind of things. But it's truly one of those where the more information that we have up front, and being an agency-only broker, there's nothing I can do with it except do the research and then do the best possible job executing the trade at the at the time of trade.
Yeah. Patrick, what about you? In the seat that you sit in, what's top of mind for you from a misconception perspective?
Yeah, less about execution, much more about client experience. As we've made a transition into a bit more focused indexation across our strategies, I've spent a lot of time with our client-facing personnel to make sure that clients are aware that every dollar in the portfolios we manage pursues excess returns. Just because you are indexed does not mean we are necessarily just looking to give you the market, right? And kind of, in essence, what am I paying you for type of question that you might get back. We're running tactical asset allocation strategy. We are running factor exposures on rewarded factors implemented in the portfolios, and we're running active strategies by dedicated active managers, where we're looking to deploy what I call their secret sauce, their edge, right? Their idiosyncratic advantage that they try to gain in a certain asset class. We're looking to deploy all three of those levers across portfolio construction. And just because I choose to be even a cap-weighted index exposure in a space doesn't mean that I'm simply looking to just provide the market exposure. I'm going to be underweight that asset class, overweight that asset class. So even in something as mundane as an S&P 500 exposure, I'm still intentionally taking a position that can create excess returns. So we spend a lot of time with our client-facing folks just making sure that clients are aware of that. Indexing doesn't automatically equal just give me the market at a low cost with no benefits.
And you touched on one of my favorite myths, is exactly that. The single largest usage of passive ETFs is in active asset allocation frameworks. It's simply, right, the deployment. I mean, I think, largely speaking, everybody would agree, investment returns are driven first and foremost by the asset allocation, right? Far more so than individual security selection. It's about getting that asset allocation right, and then capturing that idiosyncratic risk, if you will, a return that you're looking to capture. I think that's the one that is always, top of mind to me. And then the other one that I think is, really, relatively new, as we've talked about, with really the significant growth in active ETFs. And to couch that in, give a little more context around that, I talked earlier about the number of launches, but also think about this. In the last 5 years, active ETF AUM over the overall pie, so ETF AUM globally is about $10 trillion now. 5 years ago, less than 1% of the total AUM was in active ETFs versus passive. Now that is nearly 7%, and the overall ETF AUM has continued to grow. And one of the things that, we hear consistently is, but if I launch my own ETF, or if I want to package my active strategy in an ETF, it has to be cheap, because the ETF wrapper needs to be cheap from an expense ratio perspective. And I think that's a big myth. Beta needs to be cheap. Alpha has a price, and that's a much different price tag than beta. But before we go down that rabbit hole, I think we have time for a couple of more. I'm gonna again, Chad, one of the things that I hear almost every day right now, the move to T+1 settlement. A thing, not a thing? Do I need to be concerned about it? Do I not need to be concerned about it? What's your take?
Like you would talked about earlier in our call here, the unique thing about an ETF is the fact that there's a lot of in-kind transfers behind the scenes, and because of that, that kind of eliminates the T+1. And as you would talk to me about when we were working on this, you had said that a lot of the ETFs, they've been doing T+1 for years. So for ETFs, it's a non-event.
Yeah, I would agree. It's funny to me how much airplay that has gotten, and I understand that unless you were, working, for an ETF issuer, you wouldn't see the data. But the vast majority of ETF creation redemptions actually already settle on a T+1 basis to begin with. And I know we're coming up on time here, but I've saved what I think is the most topical one for last. And Chad, certainly weigh in here, but I'm going to put Patrick on the hot seat for this one. Recent approval of Bitcoin ETFs. The longest, shortest road ever from a regulatory perspective. So for many folks, I think they probably felt like this came out of the blue. It didn't. Like, this has been worked on for many, many years. How do you view them? What do you think, again, from the asset allocators, seat?
Yeah, it's still early days for us in the evaluation of it, but let me maybe share just the journey that we've taken. Fairly conservative approach by nature, fiduciaries. One of the things that concerned us about blockchain and Bitcoin was just the safety feature of the ownership stake. And I know blockchain is designed to actually create some safety measurements around ownership that are unique to it, but also the existence of some fraud cases has gotten our attention, right? So we were a bit hesitant, I would say reluctant, to really consider the exposure in client portfolios. Mainly not so much about, do we think the exposure itself is viable? It's how would we access that exposure in a way that we were confident enough where the assets would be safeguarded. The advent of the ETF wrapper and the kind of added regulatory environment that now surrounds that particular wrapper here in the US does make us a bit more comfortable that there is the potential to explore the exposure. As I mentioned at the outset, it's kind of early days for us. I would say we are one step closer to gaining comfort, and it's because of the ETF itself and what we think may be some enhanced safety provisions around safeguarding client assets. But ultimately, we're still doing our due diligence at the moment, and potentially we'll look to use it at some point in the future.
And Chad, the trader's view?
So it's definitely been a very hot topic. As soon as it was received approval, every day we get the calls, the emails confirming, can you trade this QSIP? Can you trade this Bitcoin ETF? So there's a lot of talk about it. Now, as far as, large positions, large orders, we're not seeing as many of those yet. And I've actually been speaking with, the APs that we work with, and they're even saying that, right now, in a lot of cases, the secondary market is where most of your liquidity is. So it's a little bit of the opposite of what we've been talking about today on, fixed income and equity ETFs, where right now the secondary market tends to be a little better pricing than if you're going out there trying to, get a two-sided quote, because everything is so new. And, there's a lot of factors behind the scenes of, what's really the underlying on this specific Bitcoin ETF. So for right now, we're having a lot more success working these things in the secondary marketplace, taking our time and not just going out there trying to get a two-sided quote and get it all done at once because of the volatility that's involved with the underlying.
Yep. Makes sense. And with that, we are right on time. I'm going to give each of us a gold star for doing exactly that. Chad, Patrick, really appreciate you guys participating today. Really appreciate CAPIS in sponsoring this event and getting it out there. For all the viewers, again, thank you for joining us today. There's a recording of this that'll be available. If in fact you just couldn't get enough of myself, Patrick, and Chad, feel free to view us as many times as possible. And then look, get in touch. Obviously, feel free to reach out to CAPIS. Feel free to reach out to Goldman Sachs. We're always happy to continue to educate on this topic and talk about, all things ETF related. So with that, again, thank you, and everybody have a great day.